Welcome to the deep dive. We take your source materials and, well, we try to turn them into some real insight.
And today we're really getting into the weeds with AbbVie Inc.'s Q3 2025 results.
Yeah, this isn't just your standard quarterly report. It feels more like a roadmap for a huge strategic shift they're making. High stakes, definitely.
Absolutely. And if you, our listener, are just glancing at this report, you might kind of scratch your head.
Right.
Because on one hand, that top line looks great. Worldwide net revenues, $15.776 billion for the quarter.
Which is up, what, 9.1%? That's pretty healthy growth.
Yeah, and year to date, they're already at $44.5 billion. So growth is definitely happening. No question there.
But then you look at the other side of the coin, right? The bottom line. Their GAAP-diluted earnings per share, that's the standard accounting number. It plummeted.
Yeah, plummeted is the right word, down to just 10 cents in Q3 2025.
10 cents. That's an amazing, 88.6% drop compared to last year?
It is. So how do you square that circle? Booming sales, but basically zero profit on paper.
That paradox, well, that's pretty much the whole story this quarter, isn't it?
It really is. And that massive drop, it comes down to one line item: acquired IP R&D and milestones expense.
Acquired in-process research and development.
Exactly. AbbVie slammed that account with a huge $2.7 billion charge just in the third quarter.
Wow. Okay, so that one single expense basically wiped out $1.50 per share.
From both their GAAP and their adjusted earnings, yeah.
Okay, so just to clarify that for you listening, adjusted EPS usually takes out things like certain acquisition costs, one-off charges.
That's right, to give a cleaner picture of operations.
But this IP R&D expense, it's just so massive, representing real cash going out now to buy future science. It hit both numbers hard.
It shows this wasn't like a cautious quarter. This was AbbVie going all in, aggressively buying maybe the next couple of decades of growth.
It really feels like a deliberate trade-off. Short-term pain, maybe significant pain on the earnings sheet for that long-term gain or maybe even survival.
Precisely. And to really get what they're moving away from, you have to start with immunology.
Still their biggest segment, right?
Oh, yeah. Pulled in $7.885 billion in Q3. Still up 11.2% operationally, even with all the turbulence.
And the turbulence, that's mainly HUMIRA. I mean, probably the biggest drug success story of the last 2 decades.
For sure. But that loss of exclusivity, the patent cliff, well, the biosimilar competition is fully here now. US, Europe, everywhere.
So how bad is the damage?
It's maybe less of a cliff and more like standing at the bottom of a landslide that just keeps coming.
Okay.
Global net revenues for HUMIRA in Q3, just $993 million.
Under $1 billion. Wow.
And just to underline how steep that is, that's down 55.7% operationally from Q3 last year.
More than half gone in just 1 year.
Year to date, it's down 54.8%. The decline is real and it's accelerating.
Wait, okay, let me just process that. They lost over half their HUMIRA money. We're talking billions wiped out year to date.
Yeah.
And the company's overall revenue still grew 9%.
That's right.
That is just a staggering amount of lost revenue to somehow make up for somewhere else. How sustainable is that acceleration? I mean, can the new stars, SKYRIZI and RINVOQ, really keep growing this fast for long enough to truly replace that HUMIRA volume?
That's the billion-dollar question, isn't it? And they absolutely have to. Based on these numbers, though, they are succeeding wildly, actually, at least for now.
Okay, so break that down. SKYRIZI.
SKYRIZI is just on fire. Q3 global revenues hit $4.708 billion.
Okay.
That's a 46.0% jump, operationally clean jump. Year to date, SKYRIZI alone has brought in over $12.5 billion.
$12.5 billion already. And RINVOQ, the second one.
RINVOQ, yeah. Upadacitinib, that's the powerful number 2 punch. It hit $2.184 billion globally in Q3.
We saw huge growth there, too.
Oh, yeah, up 34.1% operationally. So you put those two together, SKYRIZI and RINVOQ.
That's nearly $7 billion in 1 quarter.
Exactly. They've almost fully replaced HUMIRA's peak quarterly revenue already, just with those two.
That's incredible.
Yeah.
But it's not just about swapping dollars for dollars, right? They need these drugs to have legs.
Right. And their strategy is definitely about more than just sales volume. It's expanding the uses, the indications, and locking in that longevity.
We saw some of that this quarter with RINVOQ.
We did. Multiple wins. They got marketing authorization for RINVOQ to treat giant cell arteritis, GCA, both in the US and the EU.
Okay, new indication.
And crucially, they announced positive phase 3 results. Top-line results for RINVOQ in severe alopecia areata, that's hair loss, and also non-segmental vitiligo.
So they're pushing into new high-need, high-value dermatology areas.
Yeah.
Systematically building that market.
Exactly. Plus, they've got direct clinical evidence now to back up the switch.
What's that?
The head-to-head select switch study, it actually showed RINVOQ was superior to HUMIRA
Oh, interesting.
in getting rheumatoid arthritis patients to low disease activity or remission, specifically patients who'd already failed other drugs, other TNF inhibitors.
So that's a pretty direct message to doctors. Hey, our new drug actually works better than the old one, even in tough cases.
Precisely. Switch to the newer, better option. But maybe the biggest win, the one that protects those future billions, it's the legal side.
Ah, the patents.
Yeah, they settled the patent litigation with all the generic manufacturers for RINVOQ tablets.
All of them. So what does that mean?
It means no generic RINVOQ is expected in the U.S. before April 2037.
2037. Wow, that locks it down.
Assuming they get the standard pediatric exclusivity, yes. That basically secures a core chunk of their future revenue for, what, another decade and a half?
That's huge.
Yeah.
So, okay, they've secured the current big earners, SKYRIZI and RINVOQ, for the foreseeable future.
They have. But that security and building the next wave, well, it costs money. A lot of money.
Which brings us right back to that enormous IPR&D expense line.
Exactly. That's the cost of buying the future.
So when we look at the first 9 months of 2025, the total spending on these acquisitions and license deals,
It hit $3.751 billion.
which is what, more than 3 times what they spent in the same period last year?
Yeah, last year was $1.183 billion. So this isn't just topping up the pipeline. It feels like a pretty radical shift in how they're allocating capital, right? Hunting for completely new pillars of revenue.
Hunting aggressively. Where are they placing these big bets?
They're casting a wide net, looking for innovation wherever they can find it. Let's maybe touch on 3 key deals that happen either in Q3 or just after.
Okay.
First, the acquisition of Capstan Therapeutics. That closed in Q3. Net cash cost, $1.9 billion.
Almost $2 billion. For what exactly?
For a potential first-in-class, get ready for the jargon, in vivo targeted CAR-RT therapy candidate.
In vivo CAR-T.
Aimed at B-cell-mediated autoimmune diseases.
Okay, that sounds incredibly complex. Why is that technology worth a nearly $2 billion bet? Can you break that down a bit?
I can try. So think of traditional CAR-T therapy, the kind that's already approved for some cancers. It's like getting a bespoke suit made. You have to take the patient's immune cells out, send them to a special lab, genetically engineer them to fight the disease, grow them up, and then infuse them back into the patient. Super complex, super expensive.
Right, I've heard about that. Very personalized, very intense.
Exactly. Capstan's approach is trying to do the engineering inside the patient's body. They use these tiny lipid nanoparticles, like the ones in the COVID mRNA vaccines, to deliver the instructions directly to the immune cells in vivo.
Ah, so it's like CAR-T in a bottle almost. No need to take cells out.
That's the idea, yeah. If it works, it could make this kind of powerful immune therapy vastly simpler, faster, and cheaper to give to patients, especially for autoimmune diseases, not just cancer. It could be a huge leap.
Okay, I see why they'd pay up for that potential, a potential platform shift.
What else? Well, they also put down $700 million up front for exclusive rights to a drug from Ichnos Glenmark Innovation.
Another big chunk of change.
Yeah. This one's ISB 2001. It's a tri-specific T-cell engager for multiple myeloma, so deepening their bet in oncology.
Makes sense. Oncology is huge.
And then, a really interesting move, they jumped into the obesity space.
Oh, wow. Okay, that market is obviously exploding.
Right. They paid $350 million up front to Gubra AS for an exclusive global license to a compound called GUB014295.
What is it?
It's a long-acting amylin analog, a different mechanism from the GLP-1s everyone's talking about, so a totally new area for AbbVie.
So autoimmune, oncology, now metabolic disease. They are really diversifying.
And the spending didn't stop when Q3 ended. Just after the quarter closed, they announced another big deal.
Really? Who?
Gilgamesh Pharmaceuticals paid $900 million up front for their lead asset, bredesolocin.
Bredesolocin, what's that?
It's a psychedelic compound. It's in phase 2 testing for major depressive disorder.
Wow, okay, so adding neuroscience, specifically psychedelics, to the mix, that's quite a portfolio of bets they're building.
It really is, and this incredible spending, this is exactly why those JAP earnings look so rough right now.
Right, the cost of acquiring all that future potential.
But it's crucial to remember, R&D acquisitions. It's inherently risky. Not every bet pays off.
No, definitely not. And the Q3 report actually gave us a pretty stark reminder of that, didn't it?
It did. A sobering reality check. They had to record an $847 million impairment charge in Q3.
Almost $1 billion written off. What assets were hit?
It affected two specific intangible assets. First, they took a full impairment on Rusonic. That cost them $407 million.
Rusonic. Wasn't that the device for cellulite? Uses acoustic pulses or something?
That's the one, a rapid acoustic pulse device. Basically, they decided to just discontinue development and commercialization entirely.
So $400 million down the drain because, well, the war on cellulite proved too hard to win, at least with that approach.
It's a painful write-off for sure, but it also shows they have the discipline to cut their losses when something isn't working out, commercially or developmentally.
That's important too. What was the other impairment?
The second was a partial impairment charge on Durista. That's an eye care product, an implant for glaucoma.
Partial. So they're not ditching it completely.
No, but they're reducing the sales and marketing investment behind it, which signals, lowered expectations for its future cash flows. They're basically dialing back their hopes for it.
So they're ruthlessly pruning things that aren't meeting expectations, even while they're spending billions planting these new seeds, high-risk, high-reward ventures.
Exactly, which naturally brings the question, how on earth are they affording all this? Especially while HUMIRA is shrinking so fast.
Where's the money coming from?
The answer really lies in just how strong their underlying operations still are. The cash flow.
Oh.
Operating cash flow for the first 9 months of 2025, it actually increased quite a bit, actually.
Yeah, even with a HUMIRA drop.
Yep. Hit $13.8 billion for the 9 months. That's up from $11.7 billion in the same period in 2024.
$13.8 billion in cash from operations. Okay, that's the engine. That massive, reliable cash flow is what's funding all this aggressive spending and acquisition.
It's the bedrock. And they're actively managing their finances around it, too.
How so?
Well, their debt structure is pretty dynamic. They issued $4 billion in new senior notes back in February, to keep capital handy.
Right.
But at the same time, they were also paying down debt. They repaid $6.8 billion in older senior notes and other debt that matured during 2025.
So constantly refinancing, rebalancing the portfolio, taking on new debt, paying off old debt.
Yeah, active management. And despite all this, the huge investments, the acquisitions, the debt juggling, the HUMIRA decline, they sent a really strong signal to shareholders.
The dividend.
The dividend. The board announced a 5.5% increase in the quarterly cash dividend.
Raising it again from $1.64 to $1.73 per share starting next February.
That's right. And that dividend hike is, well, it's pretty critical messaging, I think.
Oh, so?
Well, AbbVie is known as a dividend aristocrat, right? They have a long history of raising it. To hike the dividend this year, a year they're swallowing the historic HUMIRA revenue loss and spending billions on R&D that shows real confidence.
Confidence that the core business, mainly SKYRIZI and RINVOQ now, is stable enough and throwing off enough cash.
Exactly. Enough cash to cover everything.
Yeah.
The investments, the debt payments, and returning cash to shareholders. And they are returning a lot, paid out $8.7 billion in dividends just in the first 9 months of 2025.
Okay, so the core pharma pipeline, the transition plan there looks strong, or at least aggressively managed. But we should probably touch on the areas maybe facing more headwinds.
Yeah, good point. Particularly the aesthetics portfolio. That's always more sensitive to, the broader economy, consumer spending.
And we saw some weakness there in Q3.
We did. A clear slowdown. Botox cosmetic revenues were actually down 5.4% operationally.
Down. Why?
The company pointed to a few things. Unfavorable pricing, partly due to changes in their loyalty programs, some loss of market share, and notably they called out decreased consumer demand in the U.S.
People cutting back on cosmetic procedures maybe? Is that hitting Juvederm too?
Yep, the Juvederm collection, the fillers, also saw a decline, down 3.2% operationally in Q3.
So yeah, that confirms some softness across that whole non-essential consumer health market. It's often a bit of a canary in the coal mine for consumer spending tightening up.
It can be, yeah. And finally, just to round things out, we should probably mention the sort of background noise. The legal and regulatory landscape, always complex for big pharma.
Right. Anything major on the regulatory front?
Well, there's ongoing pressure. That U.S. executive order from back in May 2025, It directs Health and Human Services to keep pursuing most favored nation pricing, MFN pricing.
Right, the idea that the U.S. shouldn't pay more than other comparable wealthy countries.
Essentially, yeah. Tries to tie U.S. prices to the lowest price paid among a basket of similar countries. It's complicated how it would work, but it definitely hangs out there as a potential future risk to revenue for pretty much every big pharma company.
So a potential future headwind. Any tailwinds?
Actually, yes, a bit of good news on the tax side for them. Congress passed that One Big Beautiful Bill Act of 2025 back in July, and that's expected to be favorable for their cash taxes this year, mainly because it restored some important deductions, like letting companies immediately expense their R&D costs and allowing bonus depreciation again. Tax stuff, but it helps cash flow.
Got it. And the legal front.
Yeah.
Besides the RINVOQ settlement, any other major updates?
Well, it's always a tangled web. One interesting data point. The total amount they've set aside, accrued, for litigation actually dropped.
Dropped from what to what?
From $2.5 billion at the end of last year down to $1.5 billion as of September 30th this year.
So $1 billion less set aside suggests maybe some big cases got resolved or settled.
It could, yeah, or estimates changed. But major issues definitely remain. You've still got the massive opioid MDL, the multi-district litigation, AbbVie via Allergan is still involved there.
Right, those cases are still grinded on.
And there's ongoing antitrust litigation, stuff related to an old drug, Niaspan, but also, more relevant to our discussion, lawsuits about HUMIRA's rebating practices.
Allegations that their rebates blocked biosimilar competition.
Exactly. There's a notable case brought by the sheet metal workers' health plan on that. So even as HUMIRA shrinks,
The legal battles around how it was defended, well, those continue. It connects right back to the start, doesn't it? Managing that decline is still complex and expensive.
it really does. So, okay, let's try to synthesize all this for you, the listener. What's the big picture takeaway?
That was the headline.
I think the core message is AbbVie is executing this absolutely massive transition. HUMIRA is fading fast, maybe faster than some expected.
But SKYRIZI and RINVOQ are stepping up, performing incredibly well, maybe even better than expected.
Right, and AbbVie is using its enormous operating cash flow, that $13.8 billion year-to-date number, like a fire hose.
Using it to absorb the HUMIRA hit on one side.
And simultaneously funding these huge, future-focused pipeline acquisitions on the other. Cross-oncology, autoimmune, obesity, and neuroscience. They're buying shots on goal everywhere.
And the price you pay for that, right now anyway, is that GAAP earnings number. Just $0.10 per share in Q3. They are actively, deliberately sacrificing short-term paper profits.
To make these massive, definitely high-risk, but potentially very high-reward bets on what comes after SKYRIZI and RINVOQ.
Which leads us, I guess, to the big question you should probably be mulling over after hearing all this.
Right. We saw that huge IP R&D number, $3.751 billion spent just in the first 9 months of 2025 alone on buying external R&D.
So if AbbVie's whole model depends on constantly bringing in the next blockbusters to replace the old ones.
How many more of these mega deals, like the $1.9 billion for Capstan, the $900 million for Gilgamesh, will they need to make?
And maybe more importantly, how much sustained annual spending on this acquired R&D will shareholders tolerate?
Before that next generation of truly major drugs fully emerges, the ones that have to secure growth beyond, say, RINVOQ's 2037 patent cliff.
It really is a high-wire act, isn't it? Balancing billions in immediate spending pain against the absolute necessity of long-term survival and growth in this industry.
A fascinating balancing act to watch.
Hopefully this deep dive gave you a much clearer picture of the trade-offs AbbVie is making right now. Thanks for joining us.